Today we're going to look at the company Grupo Aeroportuario del Pacífico, headquartered in Mexico and traded on New York Stock Exchange under the ticker PAC. Please stay tuned for the important disclosure information at the conclusion of this video. Founded in May 1998 as part of Mexico's national airport privatization, Grupo Aeroportuario del Pacífico began by operating 12 airports in the Pacific and Central regions. The company, which trades under the ticker PAC, went public in February 2006 with a dual listing on the Mexican Stock Exchange and the New York Stock Exchange, utilizing the capital to modernize infrastructure and expand into non-aeronautical services. Expanding its portfolio, PAC acquired Sangster International Airport in Jamaica in 2015 and later Norman Manley International Airport in 2019, while launching the innovative Cross-Border Express, a pedestrian bridge connecting Tijuana to San Diego, in 2015. Currently, the company is executing a massive investment plan for 2025 to 2029 focused on sustainability and digital modernization. Grupo Aeroportuario del Pacífico operates as a diversified infrastructure platform that leverages a dual-engine business model to capture value from both aviation operations and commercial retail. The core of the business is its aeronautical division, which generates approximately 70% of total revenue through regulated fees charged to airlines and passengers for the use of runways, terminals, and security services. These fees are subject to government-set price caps, providing the company with a stable and predictable cash flow base. The high-margin non-aeronautical division complements this by monetizing passenger footfall through duty-free shops, food and beverage concessions, VIP lounges, and parking. PAC has aggressively expanded this segment, recently integrating real estate developments like the Hilton Garden Inn at Guadalajara Airport and industrial parks to capitalize on nearshoring logistics. PAC's market is strategically balanced across three distinct segments: leisure tourism, business travel, and visiting friends and relatives. Internationally, the company has extended its footprint to the Caribbean, managing the two largest airports in Jamaica, Montego Bay and Kingston, which provide valuable USD-denominated revenue. Its customer base is deeply international. Nearly 78% of its international traffic originates from the United States and Canada, making the company a primary gateway for North American travelers heading to Mexico's Pacific resorts. Over the past 2 decades, Grupo Aeroportuario del Pacífico has evolved from a newly privatized regional operator into a sophisticated international infrastructure giant. Its financial trajectory reflects the broader modernization of Mexico's aviation sector, moving from a heavy reliance on traditional passenger fees toward a high-margin, diversified commercial model. In the early years following its public listing, the company focused primarily on scaling its domestic footprint, with revenue growth tightly tethered to Mexican tourism and industrial activity. This period established the foundation of its aeronautical income, which remains the bedrock of the company's cash flow. As the company matured, a strategic pivot toward non-aeronautical services transformed its terminal environments into vibrant commercial hubs. By optimizing retail space and introducing luxury concessions, PAC managed to decouple a portion of its growth from purely regulated tariffs. The introduction of the Cross-Border Express served as a landmark innovation, effectively expanding the company's catchment area into the United States and creating a unique binational revenue stream that distinguished it from regional competitors. This era of expansion also saw the company look beyond Mexican borders, successfully integrating major Caribbean gateways into its portfolio and adding valuable foreign currency exposure to its balance sheet. In more recent years, the business has successfully navigated global disruptions by leveraging its concentration in leisure and visiting friends and relatives markets, which proved more resilient than traditional business travel. The current phase of the company's history is defined by a massive reinvestment cycle and the pursuit of industrial logistics. By integrating bonded warehouses and airport-adjacent hotels, the group is now capitalizing on regional manufacturing trends, ensuring that its revenue streams are as much about cargo and commerce as they are about passenger movement. The financial evolution of Grupo Aeroportuario del Pacífico over the last 2 decades tells a story of remarkable resilience, strategic diversification, and high-efficiency infrastructure management. The primary driver of this journey has been the company's ability to convert a steady stream of aeronautical and non-aeronautical income into high-quality operating cash flow, even in the face of significant macroeconomic shifts and global industry disruptions. In the initial years following its public listing, the business focused heavily on establishing a stable operational baseline. During this period, the relationship between revenue and operating cash flow was largely defined by the steady nature of regional tourism and domestic business travel. The cost structure was relatively lean, with service expenses primarily tied to terminal maintenance and security. As the company matured, it began to aggressively optimize its service costs, leveraging economies of scale across its network of airports. This efficiency meant that as more passengers flowed through the terminals, the incremental cost of servicing each additional traveler grew at a slower rate than the revenue generated, leading to an expansion in cash flow margins that set the stage for later international ventures. The transition from the first decade into the second marked a significant shift toward a more sophisticated commercial model. The company moved beyond being a mere landlord of runways to becoming a powerhouse of retail. This change is visible in the widening gap between basic operating expenses and the resulting cash generation. By bringing high-margin services such as VIP lounges, duty-free operations, and parking in-house, or under more favorable concession terms, the group was able to buffer itself against the regulated nature of aeronautical fees. This commercial engine provided the necessary capital to fund more ambitious infrastructure projects without overly relying on external debt, creating a self-sustaining cycle of growth and reinvestment. Following that period of volatility, the group entered a phase of massive capital intensity. This era is characterized by a significant step up in investment toward airport modernization and capacity expansion. The increase in capital expenditure reflects a long-term commitment to the Mexican government's master development plans, ensuring that the airports remain competitive and capable of handling larger aircraft and higher passenger volumes. Despite these heavy outlays, the underlying strength of the operating cash flow has been sufficient to maintain a healthy free cash flow position. This demonstrates the company's cash cow characteristics, where the core business generates more than enough liquidity to fund its own future growth while still rewarding long-term investors. The most recent years of the company's history highlight a strategic focus on the nearshoring trend affecting the Mexican economy. By investing in logistics hubs and industrial real estate adjacent to its primary airports, the group has added a new dimension to its cash-generating capabilities. This move into industrial infrastructure diversifies the revenue mix further, providing a hedge against the seasonality of tourism. The financial results of this period show a company that is no longer just an airport operator, but a critical logistics and commercial partner for the entire North American trade corridor. Grupo Aeroportuario del Pacífico manages its capital with a clear priority on returning value to shareholders while maintaining the liquidity necessary to fund its mandatory infrastructure investments. Over the last 20 years, the company has transformed from a newly privatized entity with a lean balance sheet into a sophisticated financial operator that balances high-yield dividends with strategic international expansion and prudent debt management. The capital allocation strategy is characterized by a yield-plus-growth approach. In the years following its listing, PAC primarily focused on domestic growth, but as cash generation accelerated, it began a consistent program of returning surplus capital to investors. This is most evident in the dividend row, which includes both regular annual payouts and special one-time distributions often triggered by years of exceptional passenger traffic. Strategically, the company has remained disciplined, with significant capital outlays for acquisitions occurring only when clear synergies existed, such as the entry into the Jamaican market. This international expansion was funded through a mix of internal cash and carefully timed debt issuances. The company's share repurchase activity has historically been more tactical than its dividend policy, often serving as a secondary tool to manage share price volatility or to offset dilution. In more recent years, particularly in the post-pandemic rebound, the company has authorized larger buyback programs as part of its comprehensive shareholder return strategy. Reconciling these outflows against the cash on hand reveals a management team that prioritizes liquidity. The cash position has generally trended upward over 2 decades, providing a safety net that proved vital during industry-wide travel disruptions. This disciplined reconciliation of free cash flow against debt, dividends, and strategic investments highlights why PAC remains a cornerstone asset for both income-focused and growth-oriented institutional investors. The leadership and ownership of Grupo Aeroportuario del Pacífico reflect a sophisticated mix of experienced operational management and strategic private sector influence. At the helm of the company is Raúl Revuelta, who has served as the chief executive officer since April 2018. With over 20 years of sector experience, Revuelta initially joined the company in 2005, serving in various high-level roles, including chief financial officer and commercial director until 2015. The ownership structure of PAC is anchored by a 15% strategic stake held by the Aeropuertos Mexicanos del Pacífico consortium. This consortium is controlled by prominent Mexican families, alongside Spanish technical operator INA. Institutional ownership is about 44%, individual insiders about 7%, whereas general public holds 34%. Unfortunately, the liquidation value of the company is negative. Let's build a scenario-based dividend discount model. The future of Grupo Aeroportuario del Pacífico is inextricably linked to the broader economic integration of North America and the continued evolution of Mexico as a global logistics and tourism powerhouse. The trajectory of the company will likely be defined by its ability to transition from a traditional airport operator into a holistic infrastructure manager. This evolution depends on several external catalysts, most notably the permanence of the nearshoring trend, which has the potential to transform airports like Guadalajara and Tijuana into critical hubs for high-value manufacturing and e-commerce. In an optimistic scenario, the company thrives on a perfect storm of sustained industrial expansion and a revolution in cross-border travel. This scenario envisions the binational status of its key assets becoming a gold standard for international transit, where seamless integration between the United States and Mexico drives unprecedented commercial activity. Under these conditions, the company would significantly ramp up its investments in non-aeronautical services, turning terminals into retail and logistics destinations that generate high-margin cash flow far exceeding traditional passenger fees. This aggressive growth would likely be accompanied by a bold international strategy, seeking to replicate its Jamaican success across other high-growth Caribbean or Latin American markets. A more grounded, base-case scenario sees the company maintaining its steady dominance by successfully executing its long-term development plans. In this narrative, the group continues to benefit from the organic growth of the Mexican middle class and the reliable draw of its coastal resorts. Management remains disciplined, balancing the heavy capital requirements of airport modernization with a commitment to consistent shareholder returns. This path assumes a stable regulatory environment where the company and the government maintain a productive partnership, ensuring that tariff structures remain fair and predictable. Dividends remain the primary vehicle for returning value, supported by a mature and highly efficient operational model. Conversely, a more cautious outlook of the bear case scenario considers the potential for regional economic stagnation or heightened competition from alternative transport infrastructure. If global shifts move away from current manufacturing hubs, or if regulatory changes in Mexico become more restrictive, the company might pivot toward a defensive strategy. In such a scenario, growth would be driven by essential travel and cargo rather than luxury tourism expansion. Capital allocation would likely shift toward maintaining existing assets rather than aggressive expansion, with a focus on preserving liquidity and protecting margins through rigorous cost-cutting and digital automation. Even in this more constrained environment, the essential nature of its gateway assets provides a defensive floor, ensuring the company remains a central pillar of regional trade. In the bull case scenario, we assume the following: revenue growth at 10.5%, operating cash flow margin at 58%, capex growth at 9%, stock-based comp growth at 4%, dividends growth at 13.2%, stock repurchase growth at 8%, acquisition spending in the next 20 years at 20 billion peso, stock repurchases assumes price-to-sales ratio of 5. With this discounted at 10% dividend model yields $251 worth of value per share in 20 years, for $169 in 30 years and $780 in 40 years. In the base case scenario, we assume the following: revenue growth at 7.5%, operating cash flow margin at 52%, CAPEX growth at 6%, stock-based comp growth at 3%, dividends growth at 8.5%, stock repurchase growth at 5%, acquisition spending in the next 20 years at 8 billion peso. Stock repurchases assumes price-to-sales ratio of 5. With this discounted at 10% dividend model yields $157 worth of value per share in 20 years, $231 in 30 years, and $300 in 40 years. In the bear case scenario, we assume the following: revenue growth at 4%, operating cash flow margin at 45%, CAPEX growth at 3.5%, stock-based comp growth at 1.5%, dividends growth at 3.3%, stock repurchase growth at 2%, acquisition spending in the next 20 years at 2 billion peso. Stock repurchases assumes price-to-sales ratio of 5. With this discounted at 10% dividend model yields $99 worth of value per share in 20 years, $121 in 30 years, and $133 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.